Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. My special guest today is Jeff Macke. He's founder of Macke Asset Management. He's an investor, financial expert, former hedge fund manager, and original cast member of CNBC's Fast Money. Jeff, thanks for joining me today.
It's great to be here.
We're going to talk about the retail industry and some of the trends happening there. But, just kind of prior to even your TV days, and did you focus on retail through your hedge fund and through investing? Have you had a background in retail?
You know what? I grew up kind of a Target brat. My dad he worked at Target, which was Dayton Hudson at the time, from when he graduated undergrad until he was 46, 47 and retired from there. So I kind of grew up in Target stores and faced that way. Normally, it's not that exciting of an investment space, but right around 5-6 years ago, as e-commerce developed critical mass, what you're seeing now is something we've seen in retail kind of on a generational basis, which is a switch in the way people buy things. You think about the great fortunes in American history. You had the Sears fortune that was raised off the development of stores, in the cities. You had Walmart taking over from them. The Wallens are still one of the richest families in the world. Jeff Bezos took over from there. So while you have this moribund sort of 4 or 5% net profit industry in retail, every once in a while you see a channel shift. And when you take $6 trillion of the US economy and you distribute it one way for 25 years and then move it to another way, as we're seeing now with e-commerce, there's a lot of money to be made. And so that opportunity became something that was just too big for me to ignore on the consumer side. And I really dedicated what I do less to retail per se than really just consumer behaviors overall, because that shifting in American habits, it got a huge boost from COVID, but that was happening already. And so what we've seen is an acceleration in an existing trend where everything consumer facing has become normalized with an online component, meaning that, people's grandmas can work an app now. That wasn't the case before. At this point, we'll talk about Omnichannel, but Omnichannel, what that really means is just buying however you want to. That was a theoretical idea about a year ago because most grownups wouldn't instinctively reach for an app. Now it's just second nature. When you look at the way consumers behave, there's a huge habitual component. It's very hard to get people to switch from one store to another. Think about going to your grocery store. Most people have no loyalty to the actual brand, the name on the store. They just buy their groceries at spot X. That's their habit. That's what they do. Whatever day they do it, they show up. And to get them to stop takes, armed militia, basically. Once you get people to change their consuming habits, they stay changed. And so a lot of these shifts that you're seeing in market share and pie size and distribution, they're going to stick. And so my job is to really figure out what that's going to be worth over the long haul and what percentage of this growth is going to last as we normalize the economy, as we open things up again. The bar for getting people to leave their houses and actually experience things in the way that consumers traditionally do is much higher now. That's going to continue. And so what I want to be is invested in the companies that do the best job of delivering product, delivering what they sell to consumers in whatever way consumers want it, because that is the future. And any hesitation, any delay of gratification just comes across as almost an act of aggression by a retailer at this point.
Yeah, we're seeing that transition in consumer preferences and consumption in other industries. And I guess I probably should have expected it here as well as technology becomes more prevalent and adopted by the companies. I was looking at a couple of the big ETFs in the space. Just on a general basis, they're up double digits this year. I don't know why I was kind of surprised by that, but should I be, or is that surprising at all that they're up, kind of given COVID's impact on the economy? You walk around, you see some stores boarded up, you hear about some stores closing, but some other ones are doing really well.
There's been an absolute tremendous shift in the amount of value and the amount of worth going from the haves away from the have-nots. The have-nots being any retailer that you think of. If you walk through a mall, you've heard of most of the stores. You walk by Victoria's Secrets, a Gap, a Banana, the stores you've heard of. But there are for every one of those, every big public retailer that you see, there are half a dozen people that have started a store that have maybe 3 of them. My daughter works at a place and we've been helping them out over this crisis. She has 4 stores, and that's where the share is going. And so I guess to answer the question, is the surprise intuitively because you hear the companies that are doing bad are doing apocalyptically bad. You can't come up with a worst case scenario than we didn't have our online built out and they closed every single mall in the entire country. That wasn't in anyone's plans as of March. But the people that did have e-commerce ready to go are reporting sales and increases in growth rates that just look like misprints. Lululemon disappointed somewhat last quarter, and I should be so lucky to disappoint anyone with numbers like that. 155% digital growth rate. Lululemon has gone from being a sort of prototypical omnichannel, meaning they can sell it to you online or in the stores, to being predominantly online. They're doing more than half their business easily online right now. And so you contrast a company like that with the stock that is admittedly ridiculously expensive, but how can you value them versus, say, a Macy's that if the mall's closed, they're closed? That's a huge difference. And so they're gaining so much share that it's almost just an embarrassment of riches. Now, they'll get some of that back once you normalize the chains. But as it happened, when we went into this crisis, the have-nots just didn't have the cash to put themselves together. If you look at what Macy's did to their balance sheet, if you look at what a lot of these companies were forced to do to create liquidity, it didn't leave a lot of meat on the bone. And so now you can save a company like JCPenney, but that doesn't mean anything for the equity holders. As an investor, it's a great time to kind of stick with winners. And the value stuff just looks more and more like value things because there is simply no way to kind of see how these companies get from where we are now, which is totally cash constrained, didn't order anything for Christmas because they didn't have the money, not sure how they're going to pull the inventory together. And it's whether or not California malls are open seems to be up to the whims of the governor and is so politically laden that it's almost impossible to guess. That kind of uncertainty is really hard for smaller chains to deal with. And so we've seen a migration of the value to going from the people who don't have it working to just huge bonanzas for the companies that do.
So you mentioned e-commerce, and I got to admit, the last time I talked to you was the first time I heard of Omnichannel. And maybe we can kind of dig into that a little bit, because I think it's a little more nuanced than just I have a website and I can take orders and I have a brick and mortar store, right? I think it's also kind of about the experience. Social media comes into play.
It's a full integration. We spent 20 years. It's not as though the big merchants didn't see online coming. Target.com opened in 1998, I think. Walmart right behind that. So they spent 20 years with kind of appending .com to the end of the store name and deciding that was their online business. That has shifted to more of the Lululemon model, which is we just make stuff. We make athletic apparel, and we genuinely are as close to indifferent as possible as to whether or not customers go to our store. They use our app. They go online from their desktop. Omnichannel means that if you want something, it's going to be able to be purchased anywhere at any time, whenever you want it. Now that frees up the companies to do things like close on Thanksgiving. Black Friday this year means nothing. That impulse component of it is a huge driver for retail sales on the margin. I have no idea what percentage of Amazon sales are done by people who barely remember buying the stuff, but it's got to be pretty big, and that's what omnichannel is. Think about omnichannel food. You don't have to go out to eat anymore for almost anything, which is crazy. And you can call it by a lot of different names. It's the gig economy, that whatever you want to call it. But for my money, omnichannel just means the companies that have blurred that line to the point that when you listen to them on the calls and when you talk to them, the internet component of things is just integral to the company. They don't see the difference.
I'll point out one name, Nordstrom. I wondered if you had an opinion on. They're known to having a really good experience platform, but they've been struggling. What is the difference there with them?
The difference there is really they're married to the stores much more. And so in Nordstrom, the when you think about the size of the stores that they have and where they're located, they're not going to be able to be that magnet for a mall anymore. When mall traffic suffers, when the government closes the mall, there's any question about whether or not people are safe there or the stores are even open, that's going to impact Nordstrom traffic directly and immediately. They're just too kind of buried into that customer experience where you're working with an associate. And I always say, it's a great place to buy your first suit. Your old man takes you to Nordstrom, someone fits it, you feel like a big deal. They tailor it for you. That lends itself less well to online. And so what they've been doing is scrambling to come up with a way to bring that department store full service experience into an online virtual world. That's a much less natural move than it would be for, say, a Target, where they can just come up with an app that resembles the store, that feels like the store, and really is part of the same marketing experience and comes as close as possible to replicating that. I came in for a tube of toothpaste and I filled my entire cart magic that you see from an actual Target store. They're trying to get that online. So far, Amazon has such a huge lead because they're the only ones that have been thinking about it that way, but they're not merchants. And no one in American history has ever gotten a monopoly on any form of commerce, because it's really kind of capitalism itself. If somebody's selling you something and making a fortune, I'll figure out a way to buy it cheaper and sell it for a penny less.
True. Yeah. So Walmart and Target have both been working on their e-commerce push and have put in record sales and profits recently. Do you think they take that away from Amazon a little bit? Does Amazon remain the clear number one choice for consumers?
There's plenty of room. And so if you look at the total US e-commerce pie, you had maybe 11% of the total sales were done online last year. Now, that number is up over 20% already. And so we've taken years of growth and we've stuffed it away from where Amazon would have, if it would have been gradual, there was no compelling reason for Target and Walmart to be building out and spending more online than they were already. As an investment, it did make sense. COVID changed all that, and it did it in two ways. Way one was people were desperate. You didn't need to promote. They were shopping or they weren't. If you go back to April, it didn't matter if they were getting a nickel off Tide. It mattered whether or not they were in stock on Tide. That improved the margins, which in the case of a company like Target, they ended up with $5 billion more in cash on their balance sheet at the end of last quarter than they had the year before. That was after giving out $300 million in raises. That was after reconstructing their stores to work for COVID. It was after all of the expenses associated with it. It just became a much better business driving that. And then, of course, demand took care of the rest. And so initiatives like the last frontier of online commerce was grocery. People just don't like buying grocery online. Close to $1 trillion a year industry with almost no penetration online before this year. Now it's not. Now people suddenly are willing to experiment with that. They're willing to try their grocery, buy online and pick up in store. That seemed kind of crazy before. And it was something that Target got incredible customer feedback over, but it was a little private secret. Now it's become mainstream, because what you're seeing in all the shopping is that people go to stores less and they buy more. They load up their cart. They're doing bigger baskets. And so if you can capture kind of a bigger share of your total household spend, if you're a Target, that adds up big. Because again, you take a business, you go from 4% to 5% net margins. In the case of Walmart, where they're doing $1 billion in sales every single day, all of a sudden you are just flopping cash all over the place. And these companies, Walmart has 20 odd billion dollars a year discretionary to spend. That number is now 30. That's a big difference. And so when I see them getting involved in TikTok, in the case of Walmart, even being part of that story a year ago would have really raised a lot of red flags on them being distracted. And now it's just the kind of luxury investment that they can make. It's a huge chance to be exposed to a lot of different consumers, and they can afford it because they have the cash.
Do you think that at some point these companies will all have some kind of omni-channel activity, if you will, and kind of levels the playing field? And does it just go back to being about the consumer experience and their prices and the value that they offer? Or is there enough of a runway for investors to identify companies now that have good omni-channel experience versus the other ones?
Oh, absolutely. Absolutely. I spent years generating decent returns simply by using the apps, simply by seeing who had the best apps, because that was your touch point with the youngest consumers. That was really your only customer before. Now, as we said, it's everybody. Is the runway long enough? When Lululemon came out, they were talking about, again, more than 50% of their business coming from online, and those sales being more profitable than doing them in the store. So it's not a matter of runway. It's almost a matter of preference. The stores have become something that are provided almost as a convenience for customers in a way to do extra add-on sales. But in the case of Lulu and in the case of most of these companies going forward, the economics of it make the case that really you need to be online. If you're not online, good luck with just walk-in traffic, because you're not going to see it anymore. Again, it comes down to convenience. It comes down to how hard do I have to work for this? And with very few exceptions, it's hard in this day and age to have sourcing such that you have unique product offerings that force people to go into the bowels of these malls, into the downstairs store, because I found this special little shop that has the coolest shirts. That doesn't exist anymore. People are going to do it online. Now, the advantage of that is you go from it where you would have maybe 3 locations to you are a national chain. And so with social media, we've seen a couple different trends. Well, we've seen endless trends, but one of the bigger ones from my perspective is formerly regional tastes have been nationalized. When I grew up in Minnesota, no, we weren't Hicks, but we were just regionalized. We were just, we saw what we saw, and that was a bunch of other kids from Minnesota. Now the trendsetters are all over the world. And what the consumer wants is simply what they see. And so you're seeing a lot of knockoff fashions. You're seeing a lot of different stores offering similar products. They're doing it faster. They're doing it more efficiently, and the consumer ends up winning. And that leads to just better sales.
So speaking of Lululemon, are you a connected fitness guy? I know they purchased the mirror, right?
They purchased the mirror. I wanted to like the mirror. I really did. I wanted to like it. It amounts to kind of a slightly larger than 42-inch flat panel TV that you put in your house and you watch people work out. I don't know. I'm a home gym guy. I'm the prototype of a customer that this connected fitness products would really appeal to, in the sense that I don't want to join a gym. I don't want to have an instructor. I don't want to be in a SoulCycle class sweating with 50 moms and me. I don't want to do any of that stuff. I bought a Peloton bike about 4 months ago, and I'm addicted to it as if it was cardio crack. It tracks my fitness better. It's a more efficient workout, and it gives me just the right level of social interaction I need. So can Lululemon do okay with the mirror? I'm not so sure, because it's relying on people doing things like jumping jacks along with someone who's on their screen, which I can do right now just going on YouTube. But with a Peloton bike and with a lot of these other connected fitness apps, again, it's just a better way to work out. Speaking as someone who's worked out at home in some form or another for as long as I've been exercising, the real thing that you were missing was a way to keep your intensity up the way you can in a class, to have that personal trainer experience. And you were missing sort of the tracking your fitness metrics. How am I doing? Am I getting better? Am I improving? Which is elemental to any kind of workout. Connected fitness changes that and makes a better mousetrap. When Lululemon pays half a whatever they pay, geez, almost $1 billion for the mirror, they're not necessarily trying to capture all the market for people jumping around in front of their TV screen. They just need to have a voice in that connected fitness world, because those gym memberships are going to go away. That's going to be a classic industry where I'm not sure how long it is before people are comfortable getting little flecks of sweat and spit and all the other fluids that fly around in a gym. But I know that capacity is going to be limited there for a really long time. And that anybody that's in connected fitness right now, the stocks are hardly a secret at this point. So you have the most desperate customers have gone about replicating some sort of gym experience in their house. Companies that are in the business of making that experience better and making it more something that former gym goers were used to and comfortable with. It has to resemble that, and it has to get guys like me on board and that expands the pie. And so I'm not sure what the potential numbers are, but anecdotally among my guy friends who would never sign up for fitness classes, they love the connected fitness once they get used to it, once they try it, and there's nothing particularly exotic about riding a stationary bike or running on a treadmill. But, you bring some interaction to it and it changes the entire equation.
Do you have a favorite instructor?
I use all of them. It kind of depends on I'll use kind of the guys who are like, let's not dick around, let's get our numbers for most of them. When I'm sore, I kind of go with the nice, attractive young ladies. But what Peloton's done, and I think this is a core piece of the investment, is they've gathered the best roster of teachers. And so that's not a question you would ask normally. You got your favorite instructor. Everyone has their favorite instructor. Leanne's my girl. I love Leanne. She's dating Ben. I know about these people. I don't watch any reality television, but I know Leanne and Ben, the Peloton instructors, are dating. How nice is that? It's you get to know these people on a weird and faux image, intimate type of level that you wouldn't get normally. These instructors are just the nice British kids next door who put me through tortures once or twice a week. That's fantastic because that's the level of relationship I want with them. It's a level of interaction that you can get. Again, I don't need a ton of new 25-year-old fitness instructor friends in real life, but it's great to have them and to be part of kind of that fitness journey with regular people. That's going to be really hard to replicate. As you know, and from this show we're doing, it's hard to create content. It's hard to create compelling content that people will tune in for over and over again. And it's not just a matter of hiring 30 fit guys around from the neighborhood. Peloton's built out a roster of instructors who are very, very good at what they do. And so when you see these connected fitness offerings from other companies, always look at what they're offering and whether or not you personally would be comfortable hanging out with these people and having them kind of guide your fitness experience. And so Peloton has the best roster of instructors, the easiest interface, and the equipment that people are the most comfortable with. That won't last forever, but it's a nice big lead. And to the point of stickiness that we were talking about before, once people get used to that, they sign up for it. I mean, I upgraded to the new Peloton bike, and I honestly didn't plan to. I'm a little embarrassed that I did. It's not a humble brag at all. It's a couple $1,000, but it was like buying the new iPhone. It was just, back in the heydays of iPhones when they would upgrade them and it would be incrementally a tiny bit better and you'd find yourself upgrading all the time. That's the way the Peloton bikes have become. That's the way their equipment has become. They're able to get features and benefits just by improving it a little bit. They're able to increase the traffic. That increases the stickiness. And again, the size of the pie that they're going for, the market that they're going for, are not people riding stationary bikes. They're people who work out anywhere and everywhere. The latter market is much bigger than the former.
You have a background, being on financial media and generating content on a regular basis, being a thought leader and having people follow you. Will we see you on financial media again?
I think been there, done that. I think my first CNBC hit was 1998, 1999. I was on the original Kudlow and Kramer show. And now Larry works in the White House and Jim is still on CNBC and iconic. But that kind of parade has gone by. In terms of financial punditry, the challenge of it is in an uptape, no one wants to hear a word you have to say because they're geniuses and people are more inclined to tell you about their stock picks when it's a bullish tape. And in down tapes, I know this from Fast Money. We went on the air, markets were at all-time high. People were rubbing my head for luck on stock picks. I told them then, and I'll tell you now, touching a bald man's head is not actually an investment process. So, God bless, and I'd let them touch my head, which was weird. But that was how things were going in 2006 at the all-time highs. In 2008, I'd have strangers coming up to me in Grand Central with tears in their eyes because they were long General Motors and Citigroup, and their broker told them they were blue chips, and now they're down 90%, and it's their retirement. And so it becomes a deadly serious game when stocks go down and stay down for a while. From the perspective of a pundit, it's really hard to move the needle in terms of how people are responding to the message you have to sell. There's just too many cognitive biases as people take in this content. They're looking for stuff that agrees with them, justifies their positions, or, someone they can use as a scapegoat if things go south. And so I think I kind of did my time there. I'm still a consumer of financial punditry, but in terms of how that works, now I'm much happier where I am actually investing and kind of doing the dirty work at this point.
Out of just curiosity, just to stay up on all of those stocks, I mean, are you just reading all day long? Were there a team of people helping you with the various points of various stocks?
It takes a village, and the advantage of social media is you can develop a pretty good network. I'm not an expert on the real estate side of things, but I know a lot of people who are. I've gotten to know a lot of people who are involved heavily in these companies that I cover just through focus. And that's a huge part of any edge you're going to collect. I run a much more focused portfolio than other people at home really should be doing, but I do that just through an intense concentration and working on this as a job. I listen to the conference calls. I read the conference calls. When a company's going to report, I listen to the last conference call they did, so I can see any tones that are reflected and the spread between the numbers that they're giving me and the reality. And that served me pretty well. So in terms of coming up with a team or how you collect that, I kind of read everything and nothing, because ultimately you have to make your final call, and you have to get to the point that you can read any piece of research and almost grade it, almost look at it and say, I agree with this, I don't agree with this, and have some sort of foundation. That requires just a ton of work. And so investing is not something that is really a part-time kind of gig. It like any other job, if it pays well, it's probably hard. So, it's to actually do this. And I started, I guess 25 years ago, I was writing for the Motley Fool on AOL, which, holy cow, Dinosaur City, man, dial up. I played the dial up sound for my kids, and they were like, what the sweet, first of all, what's a dial tone? Second of all, that screeching noise, my God. And it didn't get, if you guys could see the internet speed that it hooked us up, you'd be appalled. This is stuff that was 1,000,005 years ago. The people that have lasted, the peer groups that I had from that time, are all people that did it themselves. They're not folks that were relying on other people to give them their stock picks. You have to take that sense of ownership, and you have to allow you to have a sense of ownership, really know the companies, and really understand whether it's something you missed or it was an execution problem on the company side. Because the difference between those two is whether or not you're going to sell something or you're going to hold on to it. And that's the difference between whether you can make a living doing this or you can't.
Now, to kind of bring it home and kind of wrap all this up, is there a long-term trend you see playing out over the next several years? It could be about retail. It could be about anything, really.
It's absolutely consumption. It's absolutely consumer consuming goods. Of a $19 trillion economy, almost a third of that is going to be just straight up retail, straight up, flat out going to the store, buying things. Americans are the best consumers on earth. Can't emphasize this enough, that the shifting of that flow from the traditional model where everybody went to the store to that sort of hybrid that we had for like 15 years, where people would either go to Amazon or the store, to every store just simply being online, offline. And as far as Gen Z is concerned, there really isn't a difference. That it's when you ask them to shop Lulu, they'll pull out their app. You ask them to shop Nike, they'll pull out their app. That's going to be what you see. And if you speak to a trend that everyone will be able to watch themselves, watch for companies like Nike yanking from the stores. Watch for them to take their product and get it out of that Macy's food chain, because they can go direct to consumer in a more compelling way. That's the way that the brands are controlling their perceived value add with all the consumers. And so the future of buying $500 tennis shoes is not some guy in a referee jersey at a Foot Locker. It's buying it online from Nike, being presented as Nike wants to show it to you, because they're the best marketers in the world.
So now this is our speed round. It's called Trend or Fad. I'll throw out a few different concepts and get your quick take, whether you think it's a trend or fad.
I'm not very opinionated, but I'll give it my best shot.
Oh, come on. Spending on health and wellness, trend or fad?
Geez, I don't know. GNC just died. So if the vitamins work, the store wouldn't have died. I think that increases, but there's going to be a point where it stops. So spending on health and wellness now is largely a function of everyone's habits got changed, and we all got fat during the lockdown. So, you'll see a spike on it, but that's going to normalize. So it's a trend that is going to age like a fad.
Men's cosmetics, trend or fad?
That is going to be a trend, which is weird. And you know how they're going to do it? They're going to do it through sunscreen. They're going to do it through making men put base concealer, because less shiny faces look better. And so they'll put sunscreen with a little bit of tint. And when people hear men's makeup, they think, it's going to be like a rat video from the 80s, that headbanger ball with lots of eyeliner and lots of stuff. That's not it. What they're going to do is they're going to sneak it into your sunscreen. All of a sudden, before men know it, they're going to be putting on base makeup. It'll be gradual. It won't be as big as people think. And we are light years away from men adding rouge, unironically, to their own cheeks. But it will be, in its own way, a genuine trend.
And how about Bitcoin, trend or fad?
Bitcoin is going to be an insanely lucrative fad of some sort that I can't figure out how to make money on. There are aspects of it that they're going to pluck out and make cash from, but the side of it where you can buy a coin and make just outsized returns on it, that's not going to last, simply because the economics of it don't necessarily make sense. There's something a little bit like picking yourself up off the ground by the ears about that story, of we need our own currency that's stable and reliable. And so buy this one because it's going to go up 500% the next 3 weeks. We need that to go away. And the elemental problem for Bitcoin is you have a lot of invested players that are very much tied to things like the dollar and sales tax and not allowing drug lords to transact freely. So the idea of this anonymous spending is a little bit overstated. And so the next level of that is going to be integration into the financial services. So Bitcoin itself, I'm not long the Bitcoin itself. The digital side of the secure payment things probably works, but I'm more focused on the consumer end itself. And until I can buy stuff in Bitcoin, I have a hard time taking it all that seriously.
Jeff, this has been great. Thank you so much for your time. Is there a way for people to follow you and see what you're up to?
The easiest way is probably just on Twitter, at Jeff Macke. That's really where I do most of kind of my networking now. Just because I'm a small one-man office, and if you use that as a resource correctly, and this is true for most social media, I would encourage people to be judicious about building out that specific network and kind of protecting it. I know Facebook, I don't really know how to do Instagram or TikTok, but if people want to talk to me, Twitter's kind of where I'm hanging out, because that's where all the degenerate gambler, FinTwit type of people hang out. And I'm one of them.
That's awesome. Again, thanks, Jeff. I really appreciate your time.
Sure thing. It was great talking.
And thank you for tuning in to another episode of Trends with Benefits.